सो दिस पर्टिकुलर वीडियो सीरीज़ ये बहुत काम की है। इसमें सबसे इंपॉर्टेंट सम्स है CA फाइनल AFM के लिए, जिनका आने का चांसेस बहुत हाई है। और सबसे बेस्ट पार्ट ये है कि इसमें मैंने टाइम ज़्यादा स्पेंड नहीं किया है, टू द पॉइंट डिस्कशन किया है, सम्स दिखाया है, आगे बढ़ा है। और इसके साथ PDF जो है वो इस डिस्क्रिप्शन में दिया हुआ है। इनफैक्ट आपके लिए बेस्ट क्या होगा, आप PDF का क्वेश्चंस पहले ट्राई कर लीजिए, और अगर किसी क्वेश्चन में अटेम्प्ट करते हैं तो केवल वो वाला पार्ट देखिए। तो उस केस में क्या होगा कि आपको हो सकता है ये जैसे 50 मिनट्स का वीडियो है सपोज, तो आपको केवल 5 मिनट में पूरा फायदा हो जा रहा है 10 क्वेश्चंस का। एंड यू नो CA फाइनल AFM इज ऑल अबाउट सम्स। तो 2-5 मिनट में यू आर एबल टू कवर 10 सम्स स्ट्रेट अवे। डोंट इग्नोर दिस, वेरी वेरी इंपॉर्टेंट फॉर यू टू पास। Moving into question number 38 from the PDF. Question number 38. This is from our desk. So this question has not come in the past examination. This is not from ICAI, past papers or RTP or MTP. This is from our desk, and this is from my stable. Okay? Okay. So look at the question, please. Look at the question. A foreign institutional investor. This is question number 38 from the PDF. The PDF was shared on Telegram. If you don't have it on Telegram, you can ask from 9674006144. 9674006144. Okay. A foreign institutional investor, FII, from UK proposes to invest £1 million in an emerging market. Okay, so FII will invest in an emerging market. After a careful analysis of future prospects, India and Hong Kong are shortlisted. For the next year, which is also the holding period for the FII, expected rates of return 15% India, 12% Hong Kong. 15% India, 12% Hong Kong. Withholding tax rates applicable on the returns earned are 15% India, 12% Hong Kong. Okay, so we are given the gross returns, we are given the tax rates over here. So the post-tax return in India, what is it? What is the post-tax return in India? What is the post-tax return in India? What is the post-tax return in India, please? What is the post-tax return in India? It is 15 into 0.85, which is 12.75%. 15 into 0.85, which is 12.75%. And what is the post-tax return in Hong Kong? The post-tax return in Hong Kong is 12 into 0.88. It is 12 into 0.88. What is it? 12 into 0.88. Post-tax return in Hong Kong is 12 into 0.88, which is 10.56%. Okay, everybody knows how to do something post-tax. Okay, 15 into 0.85, 12.75%, and 12 into 0.88, 10.56%. If somebody doesn't know how to do something post-tax, I think you should better revisit whether you should appear for the examination or not. Current exchange rates are given. Rupee per pound, Hong Kong dollar per pound. So सबसे पहले, sorry, I said Hindi, we have to convert pound into rupee or pound into HK dollar. So we have to convert pound, we have to sell pound. So the bid rate is relevant. Okay, we have £1 million to invest. So we will convert pound. Okay, let's start doing it, please. So please convert pound into rupee. So 1 pound into 69.5 is 69.5 million rupee. 1 pound into 1 million pound into 69.5 is 69.5 million rupee. No calculations required. You sell 1 million pound at 69.5, you get 69.5 million rupee. My alternative one is investment in India. Now 69.5 million rupees invested in India at 15 ka post-tax, at the post-tax rate of 15, which is 12.75%. So please give me, what does the amount become? 69.5 into 1.1275. 69.5 into 1.1275. Some people on that day wanted that I touch the board. But if I touch the board, I can't see you too properly. So 1 million into 69.5, that is step 1. We get rupees 69.5 million. Now this is invested in India. 69.5 million into 1.1275. What is it going to become after 1 year? It is going to become after 1 year 78.361250. Okay, million. Doesn't matter in how many places you do it. Okay, this is rupees 78.361250 million. You can do 78.36 million, there is no issue. You can do 78.36 million, there is no issue. I have done 78.361250 million because it's million going on. Okay, now it is a UK fund. So UK fund will evaluate in terms of pound. So this rupee has to be converted into pound after 1 year. So pound has to be purchased after 1 year or sold after 1 year. This rupee has to be converted into pound. So after 1 year we have to purchase pound or sell pound. After 1 year we have to purchase pound or sell pound. obviously we have to purchase pound. So we need to have the rupee per pound ask rate after 1 year. We need to have the rupee per pound ask rate after 1 year. Some people are saying we have to sell pound. That's stupidity. Today we have sold pound to get rupee, invested in India. Now we are going to use rupee to buy pound. That was stupidity. Whoever said sell pound, okay, that person should revisit what is happening. We are investing in India. Now the rupee is there. Now at the end of 1 year we have to sell the rupee and buy back pound. Okay, so we have to buy pound. Anyways, so we need the rupee per pound ask rate after 1 year. For that purpose, it is given the expected inflation rate. Expected inflation rate is given. UK 2%, India 4%, Hong Kong 3%. So UK 2%, India 4%. UK will have a lower inflation as compared to India. So as per purchasing power parity, whichever country has a lower inflation, that country's currency is expected to appreciate. As per purchasing power parity, whichever country will have a lower inflation, that country's currency is expected to appreciate. So pound should appreciate. Okay. So in that case, the ask rate today was 69.7. The ask rate today was 69.7. So the ask rate after 1 year will be 69.7 into 1.04 by 1.02. 69.7 into 1.04 by 1.02. 69.7 into 1.04 by 1.02. It's not the question of bigger by smaller. The rupee per pound is the quotation. So rupee factor by pound factor. Rupee factor is 1.04. Pound factor is 1.02. So 69.7 into 1.04 by 1.02. That's the expected, it is the expected rupee per pound ask 1 year from now as per PPP. Okay, so that is 69.7 into 1.04 by 1.02. So that's coming to 71.067. Now whether I will do it in 2 decimal place or 4 decimal place, I think examination question will tell us the same. If they don't tell us, you do whatever you want and please mention everywhere. We have done rounding of this manner. So I'm doing 71.067. Some people are doing 71.07. That's fine because the rate is big. It is 71 point. So 2 decimal places fine. But had it been 0 point something, I would have definitely taken 4 decimal places. 71.067. So after 1 year, we convert this rupee into pound. So the pound inflow after 1 year will be 78.361250. 78.361250 divided by 71.067. 78.361250 divided by 71.067. So that's coming to approx pound 1.1026 or 3 million, whatever, depending on the level of rounding off. Pound 1.1026 million or 1.103 million, depending on the level of rounding off. So this is the expected pound inflow after 1 year. Expected pound inflow after 1 year if we invest in India. So we started with 1 million pound and the expected pound inflow after 1 year is 1.1026. So the return is 1.1026 minus 1 by 1 into 100. The return is 1.1026 minus 1 by 1 into 100. So the return is coming to 10.26%. The return is coming to 10.26%. The return is coming to 10.26% approx. If you invest in India, it's coming to 10.26%. I am surprised when the sum started and I asked what is the post-tax return in India. Some people were saying 10.26%, which means that they have done the sum and they're just trying to answer whatever they've done. Okay, so 10.26% is the final answer. Similarly, you do for Hong Kong, and whichever country gives you the higher thing, that is the answer. I will not go and check the answer because this sum is from our desk where I am the king. I have done the solution. It is not ICI solution. Okay, 10.26% is the Indian return, and if you invest in India, the return in pound terms. And similarly, you find out the return in pound if you invest in Hong Kong. Whichever is higher, we go for the same. Okay. Question number 1. Tangent Limited is considering calling 3 crores of 30 years 1000 bond issued 5 years ago with a coupon rate of 14%. So 3 crore 1000 bond, 30,000 bonds were there. They were issued 5 years ago and they had 30-year maturity. So 25 years left and 14% is the coupon. The bonds have a call price of 1150. So how much are we paying extra? 150 into 30,000. 150 into 30,000 is 45 lakh. So 45 lakh we are paying extra today. Had initially collected 2.91 crores at that time. So 9 lakh was the discount. The initial flotation cost was 390. So 12 lakh 90, 9 lakh plus 390. 12 lakh 90 was the flotation cost and discount, which was being amortized over 30 years. 5 years they are amortized, 25 years amortization is left, which will hit the PL account right now. So 2 things will hit the PL account right now. 45 lakhs and 12 lakh 90,000 into 25 by 30. The company intends to sell 3 crore 12% coupon bond. That's the fact. Instead of 14, we have to pay 12 now, new bond. 25 years bond to raise fund for retiring the old bond. It proposes to sell the new bond at their par value, no discount, but the flotation cost is 4,25,000. So today the extra outflow is that 45 lakh we are paying extra and the 4,25,000. 49,25,000 is the extra outflow today. 49,25,000. 1 second. So the extra outflow today is 49,25,000. 49,25,000 is the extra outflow today. 45 lakh plus 4,25,000. The company is paying 40% tax. Its after tax cost of debt is 8%. That's a discount rate for NPV. If that is not given, we would have used 12% into post tax, 12 into 0.6. That is the post tax coupon on the new bond. But since it's given, we'll use 8%. As the new bond must first be sold and then their proceeds to be used to retire the old bond, company expects a 2-month period of overlapping interest during which interest has to be paid on old and new bond both. So let's calculate the overlapping interest on the old bond. 14% of 3 crores into 0.6 into 2 by 12. 14% of 3 crores into 0.6 into 2 by 12. 14% of 3 crores into 0.6 into 2 by 12. This is coming to 4,20,000. 4,20,000. Okay, you can check again, please. I'm checking again. 14% of 300 lakhs. Okay, into 2 by 12 into 0.6. Yeah, it is 4,20,000. Perfect. Now there are two tax shield we enjoy. Tax shield on the 45 lakh call premium, 45 lakh into 0.4. 45 lakh into 0.4. This is 18 lakhs. Yeah, 18 lakhs. We are enjoying the tax shield, and we are also going to enjoy the tax shield on the unamortized discount and flotation cost of the old bond. So if you see again, the discount was 9 lakh, the flotation cost was 390. 9 plus 390 is 1290. So 12,90,000 was supposed to be spread over 30 years. 5 years have passed. So 25 years is unamortized. So 12,90,000 divided by 30, the whole into 25, the whole into 0.4. 12,90,000 divided by 30, the whole into 25, the whole into 0.4. That is 4,30,000. 4,30,000. So 4,30,000 is the tax shield enjoyed today. Don't talk about, sir, what about the new bond flotation cost? Won't that be debited in the PL? Of course, yes, but that would be every year for 25 years, not right now. So, two outflows, two inflows, 49,25,000 plus 4,20,000. 49,25,000 plus 4,20,000 minus 18 lakh minus 4,30,000. Minus 18 lakh minus 4,30,000. What is it? It's 31,15,000. 31,15,000 is the initial investment in this bond refunding decision. 31,15,000. Now the second calculation is the annual savings, for which we do old, new. Old if not called. If it was not called, what would have been the annual outflow for the next 25 years on the old bond? That would stop. So that's the saving. But what is the annual outflow on the new bond? That's the outflow. So old minus new shall be the savings. So firstly, the post-tax coupon. So 14% of 300 lakhs into 0.6. 14% of 300 lakhs into 0.6. That is 25,20,000. 25,20,000 on the old bond. On the new bond, 12% of 300 lakhs into 0.6. 12% of 300 lakhs into 0.6. And this is 21,60,000. 21,60,000. Perfect. Next. Now, the annual tax savings. On the old bond, it is, what was it? 9 lakh plus 390. Yeah, 12,90,000 divided by 30. 12,90,000 divided by 30. The whole thing into 0.4. 12,90,000 divided by 30. The whole into 0.4. This is 17,200. And this is not double counting. Yes, sir, you already took it over there. No, this is the annual tax shield. And over here, it is, what was the flotation cost? 4,25,000. So 4,25,000 divided by 25. 4,25,000 divided by 25, the whole into 0.4. That comes to 6,800. 6,800. Okay, so we deduct it. So 25,20,000 minus 17,200. 25,20,000 minus 17,200 is 25,02,800. 25,02,800. This we start saving. Whereas 21,60,000 minus 6,800. 21,60,000 minus 6,800 is 21,53,200. 21,53,200. This we start paying. So savings is this minus this. Savings is this minus this. 25,02,800 minus 21,53,200. That is 349600. So 349600. 9600. This is the annuity, and this into annuity factor PVAF 8%, 25. I think annuity factor is given It is 10.675 last line. So into 10.675. 349,600 into 10.675 is 37,31,980. 37 lakh what? 37 lakh 31,980. That's the present value of the savings. So NPV is 37 lakh 31,980. Sorry, 37 lakh 31,980 and minus what? 37 lakh 31,980 minus what was the initial investment? Initial was minus 31 lakh 15,000. Minus 31 lakh 15,000. Minus 31 lakh 15,000. Okay, once again, 37 lakh 31,980 minus 31 lakh 15,000, that comes to 6 lakh 16,980. NPV is positive. 6 lakh 16,980 answer. NPV is positive. The bond refunding decision is viable. Okay. If you have taken classes from me in the class notes, it's beautifully dictated. All the steps, step 1 and step 2. 6 lakh 16,980. Okay, let's check their answer. 6 lakh 16,980 NPV. Where is the answer? NPV 6 lakh 69,980. So the final answer is presented right at the top, and then the working notes are there. 6 lakh 69,980 is the answer. Okay. DDM and bonus issue. Now this sum was also in our book. It must have been done in class, I'm sure. Okay. Let's look at the sum. Mr. A is thinking of buying shares at 500 each, having face value of 100, expecting a bonus ratio at the ratio of 1:5 during the 4th year. So during the 4th year, not end of the 4th year, you will get bonus 1:5. That means if you bought 5 shares, you will get 1 share bonus. Let's assume we bought 1 share, so we get 0.2 shares as bonus. So we get 1.2 shares, assuming fractional shares allowed. Okay, 1.2 shares. So for the first year we have 1 share, for the second year we have 1 share, for the third year we have 1 share, but for the 4th year we have 1.2 shares. Okay. Annual expected dividend is 20%. You know, dividend rate is applied on the face value. So it's 20 rupees for the first year, second year, third year. But the same rate is expected to be maintained on the expanded capital base. From the 4th year, you have 1.2 shares. So we have 1.2 into 20, 24. So dividend for the first year 20, second year 20, third year 20, but 4th year 24. Okay, 5th year 24. Because we are having 1.2 shares. He intends to sell the shares at the end of 7th year at an expected price of 900. That's great. 900 is the selling price, P7. Incidental expenses of the purchase and sale of shares are estimated to be 5% of market price. That means when you are purchasing the share, you are not paying 500, you are paying 500 into 1.05. You are paying 500 into 1.05, which is 525. And when you are selling the share at the end, you are not getting 900, you are getting 900 into 0.95. 900 into 0.95, which is 855. I hope you're okay. When we purchase, we pay brokerage. When we sell, the brokerage gets deducted. He expects a minimum return of 12%, discount rate, required return. Should Mr. A buy the share? If so, what maximum price should he pay for each share? Assume no tax on dividend and capital gain, as if we would have taken some dividend tax if the last line was not given. Anyways, so first part of the sum is, should we buy the share? Second is, what is the maximum price we should be ready to pay for it? So first part, we have to calculate NPV. So you already see what I have done. I did the calculation with you. Here's 1, 2, 3, 4, 5, 6, 7. The dividend per share we are getting is 20, 20, 20. 4th year 24. I hope you're okay. 20 into 1.2, 24, 24. 5th year 24 plus 95% of 900. So this is 855 plus 24. What is it? 855 plus 24. 879. 879. 879. Now we have to find the discounting factors are given. They are not given. No issues. So either by using discounting factor or directly, I tend to use it directly. Present value at the rate of 12%. So we have to find out NPV at 12%. So you find out the present value of all these figures. Okay, C1, C2, C3, C4, C5, C6 and C7. And then from the present value, you deduct 525. From the present value, deduct 525. So in that case, you will get the NPV. Okay. So please do the present value. First year 20, second year 20, third year 20, 4th year 24, 5th year 24, 6th year 24, and 7th year 879. You have to do the present value at the rate of 12%, and the C0, the initial cash flow, is 525, and you have to find out the NPV. So what is the NPV coming to? Is the NPV coming to Just 1 second, let me see what calculations are done by the institute. So the NPV is coming to 38.68. Okay, the figures are matching 20, 20, 20, 24, 24, 24 and 7th year 24 plus, oh sorry, I did a mistake. Because in the last year, we are selling 1.2 shares. So this is this into 1.2. So in the last year, we are getting 855 into 1.2 plus 24. 855 into 1.2 plus 24. 855 into 1.2 plus 24, which is 1050. 1050. Now you have to find out the NPV. Okay. Last year we are getting 1050 because we are having 1.2 shares. So the NPV is coming to 38 point something. Just check please whether it's coming or not. Okay, Institute's NPV is coming to 38 point something. The student sitting by my side is saying that the NPV is coming to 48 point something. So you will check it for yourself please. The NPV by the Institute is coming to 38.68. That means NPV is positive. So the stock should be purchased. Yes, we should purchase the share. And since the present value was 563, so we are ready to cuff out 563 today. But 563 includes 5% brokerage. So divided by 105, divided by 1.05, 563 by 1.05, what is it? 563 by 1.05, 536.19 we are ready to pay today. Are you understanding? The total, the present value total was 563. Okay, 563 is the intrinsic value, not the intrinsic value, sorry, intrinsic value including the brokerage. Okay, so I removed the brokerage 5%, so 563 divided by 105%, 536.19 is the maximum we are ready to pay for the share. Wonderful sum. Okay, nobody can say it's tough or hard. The point is that it can come in the exam. It came in the exam recently. Let's go to the next sum. So question number 3 of derivatives is on beta management using stock index futures. Very important topic. So as usual, we are given the portfolio A, B, C, D, E, 5 stocks, price, number of shares, beta. Cost of capital is 10.5% per annum. You are required to calculate beta of the portfolio. So you know how to calculate beta, weighted average, and you know how they do it. First column security, second column price, third column number of shares, fourth column market value, which is price into number of shares, fifth column weight. They calculate weight on the basis of market value. That is, do a total of the market value, say it is 20 lakhs, and then each value by 20 lakhs. Calculate the weight, and then beta, and then weight into beta. So the total of the last column is the beta of the portfolio, whatever it comes to. Okay, I think it comes to around 0.89. Second question, theoretical value of Nifty futures for Feb 13. We are standing on 1st Jan, and it's given Feb 13, so end of Feb, 58 days. And the value of Nifty is not given, as an S is not given. So in question number 3, we can see that S is 5,900. You know, while pricing Nifty futures, they apply continuous compounding. So they want to do F is equal to S into E power RT. F is equal to S into E power RT. But for that purpose, R should be a continuously compounded rate, whereas 10.5% is not continuous. So you convert it into continuous ln 1.105. ln 1 plus r, okay, ln 1.105, you'll get some 9 point something percent. That is the continuously compounded rate. So S into e power rt, 5,900 into e to the power the continuous rate into t. T is 58 by 365, 58 by 365, okay. You calculate the theoretical value of Nifty futures. Third part, the number of contracts the investor needs to sell to get a full hedge, that means target beta is 0 until Feb. If the current value of Nifty is this and Nifty futures have a minimum trade lot requirement of 200 M lot size, assume futures are trading at their fair value. So you already calculated the futures price in question number 2 now. So the number of futures contracts that are to be sold is given by the formula VP into beta T minus beta P divided by F into M. Okay, if you're not remembering by my copy, I can't help. VP, value of the portfolio, bracket, beta target minus beta portfolio divided by F into M. So value of the portfolio is that total market value column that you must have prepared in the table line, question number 1. Okay, number of shares into price, the total column, say 20 lakhs, whatever it is. That bracket, what is the target beta? 0. So 0 minus 0.89 divided by F into M. F you got in question number 2 and M is 200. Okay, so VP into beta T minus beta P divided by F into M. So we have to calculate the number of contracts and please round them off to the nearest integer. Question number 4. The number of futures contract the investor should trade if it desires to reduce the beta to 0.6. Once again, VP into 0.6 minus 0.89 divided by F into M. F is the same thing which you calculated in question number 2. M is 200. Okay, simple straightforward question. So question number 4 is on FRA and interest rate guarantee. Interest rate guarantee is a call option on interest rate. Let's look at the question. We have done the sum in class. 2 companies ABC and XYZ approach DEF Bank for FRA. Both companies want to borrow a sum of 100 crore after 2 years for a period of 1 year. Bank has calculated yield curve of both the companies as follows. So XYZ, the rates are given, ABC, the rates are given. Identify at least one reason for difference in the yield curve for the companies. So we can see that the ABC has a higher interest rate as compared to XYZ. That means ABC has a higher level of credit risk.
So ABC has a lower credit rating, higher credit risk reflected by lower credit rating. Okay, that's the answer. Why ABC has a higher yield? Because it has higher credit risk, perhaps lower credit rating. Number 2, calculate the rate of interest DEF bank would quote under 2 versus 3 FRA using the company's yield information. So you have to find out the yield of 2 into 3 FRA. Now usually in FRA, we are habituated not to use power. Okay, but then we have 6 month, 3 month, 9 month, all those rates are given. Here 2 year, 3 year rates are given. So we'll have to do just as we do in bond valuation. Okay, bigger factor by smaller factor minus 1. So for XYZ, 1.0448 cube divided by 1.042 square, the whole thing minus 1. May I repeat? 1.0448 cube divided by 1.042 square minus 1. That's coming to 5.04%. Okay, 5.04%. And for ABC, 1.0578 cube divided by 1.0548 square, the whole thing minus 1. I repeat, 1.0578 cube divided by 1.0548 square, the whole thing minus 1. That's coming to 6.38%. Okay, so the answer is 5.04% for XYZ, 6.38% for ABC. Third part. Suppose bank offers interest rate guarantee, that means call option, for a premium of 0.1% of the amount of the loan. Calculate the interest payable by XYZ if interest rate in 2 years turns out to be this. So basically we are buying a call option. Okay, XYZ is buying a call option. That means right to borrow, not an obligation to borrow. An FRA is a contract to borrow. That is right as well as obligation. You don't enjoy the downside in FRA. But in call option, you have the right to borrow. So if the rate falls, you will not exercise the call option and you will borrow from the market at a lower rate. But the problem is that they've not given the strike price. So the only way is that we will use the strike price as calculated as the FRA rate in second part. So what was the FRA rate we calculated for XYZ? We calculated the FRA rate for XYZ 5.04%. So we are assuming that we have a C plus at 5.04%. C plus at 5.04%. So in case 1, the rate is 4.5. So since the rate is lower, call option lapses. We will borrow from the market. So 100 crore into 4.5%, that is 4.5 crore. And we paid 0.41 crore, sorry, 0.1 crore premium. So 4.5 plus 0.1, 4.6 crore answer. And if case 2, if the rate becomes 5.5%, then the call option will be exercised. That means we have the right to borrow at 5.04. So we'll borrow at 5.04, not at 5.5. So our interest cost will be 5.04 crore plus 0.1 crore, 5.14 crore. Okay. So question number 4, very easy sum on the indifference return. So this particular chartered accountant, if you look at the sum, he's earning 15% by investing in stock market on his own. But now he's thinking about investing in a mutual fund. But the mutual fund charges 6% initial expense, 2% recurring expense. How much return the mutual fund needs to earn to provide Mr. Alex 15%? So obviously mutual fund has to earn more. It is 15 divided by 0.94 plus 2. 15 divided by 0.94 plus 2. 17.957%. Okay, I can say by logic and formula, suppose he invests 100, then 6% goes in as initial expense. So we are left with 94. On the 94, he has to earn x minus 2. 94. He has to earn x minus 2, okay, so that he gets 15 and you can solve for x. But what's the sense in complicating when this sum has come for around 80 times in the exam? You can straight away apply the formula, na? Which is 15% the return required by him divided by 1 minus the initial expense. That means 15 by 0.94 plus 2, okay, 17 point whatever percent. Please check the presentation of the symbols used by them. Okay, although I think they are not concerned, but still, if the sum is repeated, what's the harm in looking at the symbols used by them? Question number 2 was a new inclusion which was not done in class. Mr. Alex's current annual professional income is 40 lakhs. Now this guy is earning 40 lakhs, chartered accountant. His portfolio value is 50 lakhs and now he's spending 10% of his time to manage the portfolio. So he could have spent the same 10% on his practice, no? But he's spending 10% in managing the portfolio. Okay. If he spends the time on profession, his professional income will go up in the same proportion. So 10% of 40 lakh, 4 lakh he can earn. Okay, if he invests in mutual fund, because his time would be saved. He's thinking to invest his entire portfolio into multi-cap fund, assuming the fund's NAV will grow at 13% per annum. Okay, you are requested to advise Mr. Alex whether he can invest the portfolio into multi-cap funds. If so, what is the net financial benefit? Okay, so in the second part, we have alternative 1, invest in the mutual fund, alternative 2, invest by himself. So if we invest in the mutual fund, I'm looking at the question, I'm not going to the solution at all because there's no need. If we invest in the mutual fund, we are going to earn 13% of 50 lakhs, which is 6.5 lakhs. 13% of 50 is what? 6.5 lakhs. And we are going to earn 10% of 40, which is 4 lakhs because our time would be saved. Okay, so we are earning 6.5 lakh plus 4 lakh, which is what? 10.5 lakhs. But these guys have also added 40 lakhs. Now, I think 40 lakhs is irrelevant because he would earn anyways. But still, you want to copy the institute. So plus 40 lakh. 10.5 plus 40 is equal to what? 50.5 lakhs. So 50.5 lakhs is his income if he invests in multi-cap fund. Now, if he invests in shares by his own, then he's earning 15% when the sum started. So 15% of 50 lakhs. 15% of 50 lakhs is what? 7.5 lakhs. 7.5 lakhs he's earning and plus he's earning 40 lakhs as professional income. That's 47.5 only. So 47.5 versus 50.5. That means he can earn 3 lakhs extra if he invests in multi-cap fund. That's what you have to explain. A very, very easy question. And of course, the question should have said that in the second part, you are supposed to ignore the 6% initial expense and recurring expense. That's not given. So sir, then how did you know it? I knew by looking at the answer. Sir, you are cheating. Yes, I am cheating. Okay. If you want to clear the CA exam, you got to do as per them. Okay, when I first solved it without looking at the solution, I also included the initial expense and the recurring expense in the multi-cap part, but the institute has not done the same. So please follow ICAI. So let's come to question number 3. Now this sum is on total risk, systematic risk and unsystematic risk of a portfolio, TR, SR, UR. In fact, in this particular handout containing the best questions, I have taken 2 questions on TR, SR, UR. This is the first one, question number 3. Now I have named it ambiguous, though frankly speaking there is nothing ambiguous over here, but the reason I called it ambiguous is because there's a certain portfolio over here by the name of Mix, okay, and they have assumed this to be the market portfolio. That causes some confusion. Many people while reading the question are not able to understand the same. Also, they have confused students between ER and RE. If you remember, ER is the expected or the forecasted return, while RE is the required return as per CAPM. Now in this question, on X and Y, the average return, that is the expected return, is already given in the question. And then once again, they've asked us to compute expected return. So they have computed that by RF plus RM minus RF into beta. So student is thinking then that what was that return which was already given? So logically, the return that you compute as per CAPM, that return is RE, required rate of return. And the return which is already given in the question is expected rate of return. That is the only thing that will ensure that you understand. So in that case, if we were required to calculate alpha, we would have calculated ER minus RE. Okay, although that is not required. Let us get into the sum. You will understand more. So the sum is there in front of you. Question number 3. Mr. Abhishek is interested in investing 2 lakh, for which he is considering 3 alternatives. Invest 2 lakh in MFX, invest 2 lakh in MFY, invest 1 lakh 20 in MFX and 80,000 in Y. That means the weights are 60-40, correct? 3 options. Average annual return earned by X and Y are 15%, 14% respectively. This is the ER I was talking about. Forecasted return 15-14. Risk-free rate of return 10% RF and market rate of return 12% RM. So RM minus RF is 2%. The covariance of returns X, Y and the market portfolio mix. People are losing out this word. It is the market portfolio mix. So mix over here is the market portfolio. So we are given the variance covariance matrix. You know, we have done it in class that the diagonal, that is 4.8, represents the variance of X. 4.25 is the variance of I and 3.1 is the variance of market. Now, many people don't know this only. In the variance covariance matrix, the diagonal represents variance. Okay. Accordingly, if somebody wanted to calculate beta, okay, beta would have been so easy because the beta of X would be what? The covariance of X with market divided by variance of market. So it's 3.37 divided by 3.1. Similarly, beta of Y would be 2.8 divided by 3.1. Okay, so it's simple stuff. Anyways, let's read the question. You are required to calculate the variance of return from X, Y and market. Now, this is a joke because the variance on X is 4.8, variance on Y is 4.25 and variance of market is 3.1. How do we calculate it? It's already given. Okay, 4.8, 4.25 and 3.1, that's the answer. Okay, let's check the answer of the institute, how they have done. Now these people have gone mad and God knows what they have done. Ultimately it's 4.8, 4.25, 3.1. You can check the answer. Let's go back to the question. So the first part you don't have to calculate, the diagonal is the answer, 4.8, 4.25, 3.1. Question number 2. Calculate the portfolio return. So the portfolio was the mixed portfolio, okay, 60-40 weight. And the return on both the funds were 15 and 14. So portfolio return is 0.6 into 15 plus 0.4 into 14. Calculate the beta of the portfolio. So 0.6 into the beta of X plus 0.4 into the beta of Y. I already taught you how to calculate the beta. The beta of X is 3.37 by 3.1. The beta of Y is 2.8 by 3.1. I'm speaking all this from the question. Okay. So accordingly weighted average is the beta. Portfolio variance in SD. So portfolio variance, weight square into variance, weight square into variance, 2 into weight into covariance. So that means 0.6 square into 4.8 plus 0.4 square into 4.25 plus 2 into 0.6 into 0.4 into 4.3, the whole square root. Let me show you the answer. Let's come to the answer and see the standard deviation portion. So standard deviation portion, we come to the answer. Yes, here the institute has done 0.6 square into 4.8 plus 0.4 square into 4.25 plus 2 into 0.6 into 0.4 into 4.3. That's the variance and the square root is 2.115. Okay, let's go back to the question. If we come back to the question, they're asking us to compute the Sharpe ratio, Trenner ratio and alpha for X, Y and, third question is expected return, systematic risk and unsystematic risk. Okay, expected return over here means required return because the expected return was already given 15 and 14. So they're asking the required return as per CAPM, that RF plus RM minus RF into beta, all the figures you have. So they asked us the expected return. What did they ask us? Systematic risk is beta square into variance of market. And unsystematic is total risk minus systematic risk. So very simple. Fourth question, Sharpe ratio. Sharpe ratio is excess return to beta. Trend ratio is excess return to SD. Alpha is ER minus RE. Okay, of X, Y and portfolio mix. So please do the question nicely. It's very likely to once again come in the exam. Okay, very important sum. Question number 3. Now this is a sum based on back calculation. The language of the sum at some places is incorrect. You will find it. And also the solution to my understanding is not correct. But what is correct is defined by CA Institute. So I will definitely point out knowledge-wise what is correct or incorrect, but what matters is what CA Institute has done. So it's given on Tuesday morning. You have 7 lakhs lying in your bank account. This amount is available from Tuesday till Friday. The bank requires a minimum balance of 1,000 all the time it's given. So even if on a single day the balance falls below 1,000, it is not allowed. Okay, minimum balance of 1,000 all the time. Investor desires to make a maximum possible investment where war should not exceed the balance lying in his bank account. Now this is a mistake in the language. War should not exceed the balance lying in the bank account. That means war should not exceed 1,000. Or what should not exceed 7 lakh. That's wrong. The language should have been investor wants to make maximum possible investment such that, okay, the war, that is the loss, should not exceed an amount such that the minimum balance is breached. Okay, anyways, let me not teach English language to them. Standard deviation of the market price is 1.5% per day. Required confidence level is 99%. Okay, now you know that for 99% confidence Z is 2.33. In case you don't know, so you check out you just search for 0.99 in the center of the table, because in the center of the table we have the cumulative distribution. So we get 0.9901 if you are seeing, and that is 2.33. Okay. Anyways, I had made you remember in class that I tend to remember all this via area in the left tail, because that's the tail of loss. So 1% in the left tail means 2.33. That means 99%. 2.5% in the left tail, that means 97.5% confidence is 1.96. 5% in the left tail, important, that means 95% confidence is 1.64. 10% in the left tail, that is 90%, is 1.28. So I had made you remember this. Okay, I dictated this in class. Anyways, so we have 2.33Z. So in this case, war is known and we have to find out the amount that we can invest. Okay, so the way to go about is that I feel, according to my knowledge, that the daily loss should not exceed that 6,99,000 daily loss. But they have solved it saying that since it's a 4-day period, so in 4 days the loss cannot exceed 6,99,000. Now that's stupidity. Every day the loss cannot exceed 6,99,000, because suppose we have a loss of 7,50,000 on day 1. So we are having 7 lakh in the bank account. If 7,50,000 is the loss, we'll have a debit balance of 50,000 which the bank is not allowing. So obviously the daily loss should not exceed 6,99,000, but Institute has interpreted that the 4-day war at 2.33 should not exceed 6,99,000. Anyways, let's follow them. So 6,99,000 is the war. So you divide it by 2.33, you get what? SD of what? 4 days. You divide it by root over 4, you get what? SD of 1 day. And what is the percentage SD? 1.5%. Divide by 1.5% and you get what? The amount of the investment that can be made. So it was very fast. I want to understand once again the calculation. Okay, 7 lakh is the balance. 1,000 is the minimum allowed. So 6,99,000 is the loss we can tolerate. So 6,99,000 is the war. That is at 2.33Z. So divide by 2.33, you get the standard deviation in amount. This standard deviation according to them is 4 days. So divide by root over 4, you get standard deviation per day. But the standard deviation in amount, the SD is 1.5%. So divide by 1.5% and you get the maximum possible investment that can be made. Okay.
Long is planning to acquire Toll with the following data. So we're given the expected EPS E1 and E1, expected DPS and D1. I remember when the sum came originally with a different name. That time it was just written EPS and DPS and there was a whole lot of confusion whether this is E0 or it's E1. Here it is clear. Number of shares 30 lakhs, 18 lakhs. Current market price 180 and 50. As per an estimate of Toll Limited, Toll Limited is expected to have steady state growth of earnings and dividend to the tune of 6% per annum. Okay, so growth rate of Toll 6% per annum perpetually, even by RM Energy. However, under the new management, the growth rate is likely to be enhanced to 8% per annum without any additional investment. Now that's a source of synergy. We will make the growth rise from 6 to 8 without putting any money and without any change in risk. So therefore, there's a creation of value over there. You are required to calculate the net cost of acquisition by Long Limited if 60 is paid for each share of Toll. So if we are paying, net cost of acquisition or true cost of acquisition, it refers to how much extra we are paying to the target company as compared to the market price of the target company. So in a cash deal, look, we are paying 60, but what is the market price of Toll? 50. So how much extra we are paying? 10. And how many shares they have? 18. So 10 into 18, 180 lakhs is the answer. The first part, we don't have to value anything, no synergy, no nothing, because it's a cash deal. So how much extra are you paying to the other company? You are paying 60, the price is 50, you are paying 10 extra into 18. 180 lakhs will be the answer, no matter with what stupidity they might have done. Yeah, 180 lakhs is the answer. Second part. If the agreed exchange ratio is 1 share of long for every 3 shares of tall, okay, 1 share of long for every 3 shares of tall, in lieu of the cash consideration as per one above, what will be the net cost of acquisition? So once again we have to do the net cost of acquisition, but this time it is a stock deal. So what are we paying to short? That depends upon what shall be the post-merger share price. What shall be the post-merger share price? So post-merger share price we have to calculate. For this we have to first of all calculate synergy. So synergy in DDM is calculated this way. For tall, RE or KE is D1 divided by P0 plus G. So RE is equal to, what is the D1 for tall? D1 for tall is 3. Okay, and G is 6% right now, pre-merger. Three divided by what's the price? The price is 50 plus G is 0.06. So required rate of return is coming to, I think, 7.5%. Sorry, 12%. 12% is the required rate of return. Now, since the risk complexion is not changing, therefore required rate of return will remain the same, but the growth rate will become what? 8%. So we have to find out the new price equal to D1 by RE minus G. So D1, 3, because it's already given. I have taught you in equity valuation that if expected dividend is given and growth rate changes, D1 will not change. Okay, if D0 was given, I would have computed new D1, but if D1 is given, we should not change. I'll check the answer whether they've changed or not. Otherwise, I will cut my answer because we have to follow this. 0.12 minus 0.08. So it's 3 by 0.04, which is 75, I think. 3 divided by 0.04, 75. So 75 becomes tall's price, and the price of tall was 50. So the value of synergy according to me is 75 minus 50 into 18 lakhs, which is 25 into 18 lakhs. 450 lakhs is the value of synergy. Surprisingly, I think they have asked this in the third part of the question. 450 lakhs. In the third part, yeah, gain from acquisition. Let me check the third part. Is it 450 lakhs? Yes, it is 450 lakhs, no matter how they calculated it. 450 lakhs. So in the second question, we were doing, so what is the value of A? The value of firm A is number of shares into share price, which is 30 into 180. 30 into 180. That is 5,400 lakhs. 5,400 lakhs. 5,400. What is the value of B? The value of B is number of shares in price, 18 into 50. 18 into 50, I think it's 900 lakhs. And what is the value of synergy? It is 450 lakhs. So value of the combined firm VAB is equal to VA plus VB plus synergy. So it's 5,400 plus 900 plus 450, which comes to 6,750 lakhs. 6,750 lakhs. So share price after merger, price AB will be 6,750 divided by combined number of shares. Combined number of shares, we have 30 lakh shares of long, and we are issuing 1 share for 3 years, 3 shares. So 1/3 of 18, 6 lakh shares for the other company. 30 plus 1/3 of 18. Okay, 30 plus 1/3 of 18, that is 6 lakh shares we are issuing. So price after merger will be 6,750 divided by 36. 6,750 divided by 36. This comes to 187.5. So 187.5 you are paying to that company, 187.5. You are issuing 6 lakh shares valued at 187.5. So what is the net cost of acquisition? It is 6 lakhs into 187.5 minus the value of firm B, which is 18 lakhs into 50. Understood? Net cost of acquisition is the extra you pay to firm B. So you are issuing 6 lakh shares worth 187.5 minus 18 into 50. What is it coming to? It's coming to 225 lakhs. So 225 lakhs is the net cost of acquisition. Remember, net cost of acquisition is whatever you are paying minus The value of firm B. Value of firm B is 18 into 50. And what you're paying is 6 lakh shares worth 187.5. Okay. There is also a word called apparent cost of acquisition. Apparent. In apparent cost of acquisition, instead of this 187.5, we take our current share price. What was the current share price? The current share price was 180. So it's like you are issuing 6 lakh shares of 180. In that case, what does the answer come to? It is 6 into 180 minus 900. It comes to 180 lakhs. So there are two answers. The correct answer is 225 lakhs. It's called the true cost of acquisition. But if you value the 6 lakh shares in the current price of A, in that case, it's apparent cost of acquisition 180 lakhs. Let's check which answer matches. So here we have 225 lakhs, it's matching, and they've also given an alternate answer 180 lakhs. So they've given two answers, true cost, apparent cost. True cost is the best answer. Perfect.